This is the second part of the presentation for Chapter 24, Full Disclosure in Financial Reporting. In this objective, we will discuss the auditor's report on the financial statements and management's responsibilities for the financial statements. All public companies are required to have an audit of their financial statements by an accounting firm registered with the PCAOB. After the audit is completed, the auditor will issue an audit report. The audit report that is shown in this slide by Richardson and Associates, LLP, is prepared according to the standards of the PCAOB. The auditor's opinion on the financial statements for Raintree Company was an unqualified opinion. This is the best opinion that a company can receive. It states that the financial statements present fairly in all material respects the financial position and the results of operations for the periods included in the annual report. We will discuss the other three types of opinions that auditors may issue, which are qualified, adverse, and disclaimer, in future slides. There are some circumstances that can require an additional explanatory paragraph in the audit report. These additional explanatory paragraphs do not alter by themselves the otherwise unqualified opinion. Auditors may need to add an additional paragraph to explain that there is substantial doubt about the ability of the company to continue as a going concern. This paragraph is added when the auditors have doubt about whether the company can continue in business for at least 12 months from the end of the reporting period. If a company has changed accounting principles or the method of their application in a way that has a material effect on the comparability of its financial statements, auditors are required to add a paragraph to explain the lack of consistency. It should identify the nature of the change and refer the readers to further disclosure by management within the notes. Auditors may also add an additional paragraph to the audit report to emphasize a particular matter. Some items that might require emphasis would include that an entity is a component of a larger business enterprise, or that the entity had significant transactions with related parties. Auditors may find that they must qualify their audit opinion on the client's financial statements. Qualified opinions are used when there is a scope limitation that is material but not pervasive over the financial statements. A scope limitation refers to the inability of the auditors to perform all of the necessary audit procedures that might otherwise be required. An example of a scope limitation would be if the auditors were unable to observe the taking of ending inventory that is located in another country. If this inability to observe the inventory was of sufficient magnitude, but not so serious as to invalidate their ability to issue an opinion, the auditors might qualify their audit opinion as it pertains to the inventory. Auditors may also issue a qualified opinion when there is a lack of conformity with GAAP or inadequate disclosures. If, for instance, a company used the direct write-off method of recording bad debt expense instead of the allowance method, the auditor would issue a qualified opinion if the lack of conformity was material but not pervasive over the financial statements. Likewise, if the company refused to provide adequate disclosure of contingencies, the auditors might issue a qualified opinion if the lack of disclosure was material but not pervasive over the financial statements. Auditors will issue adverse opinions when the exceptions to the fair presentation are so material that a qualified opinion is not justified. The difference between the qualified opinion and the adverse opinion is a matter of degree. The more material the effect of the lack of conformity with GAAP or disclosure is on the financial statements, the more likely the auditor will have to issue an adverse opinion. Normally, a qualified opinion is indicated when the matter is material, and an adverse opinion is indicated when the matter is pervasive. The adverse auditor's opinion will state that the financial statements do not present fairly in all material respects the financial position and results of operations for the periods presented. Adverse opinions are rare because the SEC will not permit a company listed on an exchange to have an adverse opinion. Thus, most companies faced with the prospect of receiving an adverse opinion will adjust their financial statements so they are in conformity with GAAP. The last type of audit opinion is not really an opinion at all. When there is a scope limitation that is pervasive, the auditors may decide not to issue an audit opinion at all. The auditor's report will be changed to indicate that no opinion is issued because they were unable to obtain the necessary information upon which to base an opinion. As is true with qualified and adverse opinions, a qualified opinion may be indicated for a material scope limitation, and a disclaimer may be indicated for a pervasive one. Also, if the scope limitation is client imposed, then it is more likely that a disclaimer will be issued. Using the previous example where a client's inventory taking could not be observed, if the inventory was material to the financial statements, then a qualified opinion would be indicated. But if inventory was so large that the lack of observation would cause the auditors to be unable to issue an opinion at all on the financial statements, then a disclaimer would be appropriate. The SEC requires that management include in the annual report a discussion and analysis section that highlights both favorable and unfavorable trends related to liquidity, capital resources, and the results of operations. They should also include significant events and uncertainties that affect these same three areas. The MD&A obviously contains estimates, opinions, and soft data, but the SEC believes that including this information exceeds the potential lack of faithful representation. Within the MD&A section, management should include a discussion of the company's critical accounting policies. Also, within the MD&A section, management should describe the risk that the company expects to its operations, as well as their efforts to mitigate those risks. This multiple choice question is to check your comprehension of the MD&A section. The MD&A section of a company's audit report is required to cover liquidity, capital resources, and results of operations, as we indicated in the previous slide. The other information shown on the slide would be covered in other areas of the annual report if applicable. After Sarbanes-Oxley was passed, the SEC began to require that management provide additional disclosure and reports. One of these concerns management's responsibilities for maintaining effective internal controls over financial reporting and the results of their annual evaluation of the effectiveness of the internal controls over financial reporting. This is an example of the report of Home Depot's management for their responsibilities for financial reporting and their evaluation of the effectiveness of the internal controls over financial reporting as of January 28, 2018. They also state that KPMG LLP, their external auditors, have also audited the internal controls over financial reporting, and their audit opinion is included in a separate report. The Chief Executive Officer and the Chief Financial Officer are required to sign these reports to acknowledge their personal responsibilities. In this learning objective, we will identify reporting issues related to fraudulent financial reporting and financial forecast and projections. It is unfortunately a reality that there is fraudulent financial reporting that results because of a company's intentional or reckless conduct, whether act or omission, that results in materially misleading financial statements. Some of the more spectacular examples of financial fraud are shown in this slide. Pressures to commit financial fraud can include sudden decreases in revenue or market share, either for a single company or the entire industry. Unrealistic budget pressures or financial pressure resulting from bonus plans. It is important for auditors to consider these pressures when they are evaluating the risk of the company to commit financial statement fraud. This slide represents the results from a global survey of 7,200 executives from 123 countries concerning economic crime. As shown, 49% of the executives reported their organization had experienced some type of fraud and/or economic crime within the last 24 months. These results show that fraud is increasingly a serious concern for most organizations. As shown in this slide, asset misappropriation is the single largest source of fraud reported, but it is important to note that cyber crimes are becoming much more prevalent in many industries. Some of the common causes for financial statement fraud are the desire to obtain a higher stock price, avoid default on a loan covenant, or to make some sort of personal gain like a bonus or promotion. These are the pressures that will cause management to begin to try and find a way to manipulate financial statement reporting. When auditors are considering the risk of financial statement fraud, they first look for the pressures and then opportunities to commit the fraud, as well as some type of rationalization of the fraud by the perpetrators. This is what is called the fraud triangle. Most financial statement frauds are committed by managers who intentionally mislead the users of the financial statements. The opportunities to commit fraudulent financial reporting include weak boards of directors or internal accounting controls, unusual or complex transactions, accounting estimates that require significant judgment, or ineffective internal audit staffs. More and more companies are providing financial statement and other information on their websites because it helps them to communicate the information faster and more easily and with less cost to their users. Users are able to use search engines and hyperlinks to more readily access the information that they need. It can also help to make the financial statements more relevant by companies reporting expanded, disaggregated, and more timely data. As we mentioned earlier in the presentation, the SEC favors reporting prospective or forward-looking information by companies. There are two types of prospective information: financial forecasts, which report what the company expects its financial position, results of operations, and cash flows to be in the future, based on conditions that it expects to exist and the course of action it expects to take, and then financial projections that report what may happen based on one or more hypothetical assumptions. The difference between the two is that a financial forecast reports what is expected to happen, and the projection reports what might take place but is not necessarily expected to happen. There is currently a debate about the inclusion of forward-looking information. Companies are hesitant to provide this type of information, which many analysts, the SEC, and users would prefer because they don't want to get sued. The SEC issued a safe harbor rule to encourage management to disclose prospective information. It provides protection to a company that presents an erroneous forecast as long as the company prepared the forecast on a reasonable basis and disclosed it in good faith. However, in practice, some companies still have been sued by investors, and the safe harbor rule does not cover oral statements. This is a multiple choice question to check your knowledge of the difference between a financial forecast and projection. The correct answer is that a forecast attempts to provide information on what is expected to happen, whereas a projection may provide information on what is not necessarily expected to happen. In this objective, we will discuss the approach to financial statement analysis. Financial statement analysis attempts to use historical financial statement information to provide some information about what might happen in the future. It is important to use a logical approach to financial statement analysis. First, you need to know what questions you need answers for, and then pick the appropriate ratio or comparison that will help you to answer those questions. For instance, short-term creditors are most interested in the ability of a company to meet its short-term obligations. Bondholders are interested in long-term indicators, including the company's capital structure, past and projected earnings, and changes in financial position. Along with the information desired by bondholders, stockholders are focused on the company's earnings picture because those changes affect the stock price. Managers are interested in all of the information because they are responsible for the company's creditworthiness and earnings. They use ratios also for internal operating decision making, such as capital budgeting and break-even analysis. It's important to understand that the financial statements are reporting historical information, or that which has already occurred, so any use of that information to predict the future has to be tempered with the fact that circumstances can change and quickly. Also, no single ratio is of much use in making decisions. Only by looking at the ratio in context, either in comparison with other companies in the same industry or in relationship to prior years, can you make an informed decision. Last, the information provided in the financial statements is a product of the accounting system, which brings its own set of limitations to the analysis. In this objective, we will identify the major analytic ratios and how to calculate them. There are different analytic tools used in financial statement analysis, including ratios, comparisons, and percentages. No one device is more useful than the others. Different situations call for different analytic techniques. Usually the starting point is ratio analysis. There are 4 basic categories of ratios, and each provides a different measurement of the company. First, there are liquidity ratios, which measure the ability of the company to meet its short-term obligations. Second, there are activity ratios that measure how effectively the company is using the assets employed. Third, there are profitability ratios that measure the success or failure of the company or division over time. And fourth are coverage ratios that measure the degree of protection for long-term creditors and investors. These are the liquidity ratios. The current ratio is the most liberal of these because it includes in the numerator all of the current assets. For a stricter liquidity calculation, the quick or acid test ratio only includes cash, short-term investments, and net receivables in the numerator, but all of the current liabilities in the denominator. The inventory and prepaids are excluded from the numerator because inventory may be slow moving and prepaids are not easily converted to cash. The last ratio is the current cash debt coverage that only includes net cash provided by operating activities in the numerator, and the denominator is average current liabilities. This is probably the most stringent measure because it uses only the cash currently being generated by operations in the numerator. Activity ratios include the turnover ratios for accounts receivable, inventory, and assets. The higher the ratio, the faster that the company is collecting cash, selling merchandise, and generating sales. Again, the ratio by itself is not informative, but in context with other comparable companies or other years, these ratios can be helpful in analyzing operations. Profitability can be measured in various ways, but provides a means of determining if the company's operations are generating sufficient earnings. Profit margin on sales provides the income generated as a percentage of net sales. Return on assets compares net income to average total assets. Investors are interested in the return on their investment as measured by the return on common stock, earnings per share, and payout ratio. Coverage ratios are important to the long-term debt holders and the investors. If a company has a high debt-to-asset ratio, it indicates that the company may be at risk of being unable to meet its long-term obligations. The times interest earned ratio provides a measure of the relative ease of a company in paying its current interest obligations out of earnings before interest and taxes. The cash debt coverage is a long-term measure of the ability of the company to meet both short and long-term obligations out of cash generated by operations. Book value per share indicates the amount of assets of the company for each share of common stock. In this learning objective, we will discuss some of the limitations of ratio analysis. Analytical tools are attractive because they are simple and convenient to use, but decision makers should not base their decisions solely on these ratios. One reason is that financial statements use historical costs, which can cause distortions in measuring performance. Also, there are many uses of estimates in accounting, such as the useful life of assets and bad debts expense. Where the use of estimates is substantial in financial statements, the income ratios can lose some of their credibility. Due to the nature of accounting, it can be difficult to achieve comparability among companies, even in a given industry. Much of this is due to the fact that accounting provides for different principles, and sometimes it is difficult to identify basic differences and adjust the balances of companies to achieve comparability. Some of the problem areas are inventory valuation, depreciation methods, capitalization versus expensing of certain costs, investments valued at equity versus fair value, and differing treatments of post-retirement benefit cost. Last, there is a substantial amount of information that is not included in a company's financial statements, as we discussed in the first presentation. Events such as industry and management changes, competitors' actions, technological developments, and government and union activities are often critical to a company's success, and they occur continuously, and information about them is reported in the media and other sources. In this objective, we will discuss techniques used in comparative analysis. To illustrate comparative analysis, we will use this illustration of Analytic Chemical Company. As you notice, the company's net income has increased substantially over the 20 years from 2000 to 2020. However, it is important to remember that the value of the dollar would have changed substantially over this time period. The shorter time horizon of 3 years is much more comparable, since the dollar would have remained fairly stable over the short term. In this objective, we will describe techniques of percentage analysis. Using the Analytic information previously presented, this slide shows income statement information and the use of horizontal analysis. Horizontal analysis is used to show the percentage change in accounts over time. It is especially useful in evaluating trends because absolute changes are often deceiving. To illustrate the technique, we will look at cost of sales. The absolute amount of change from 2019 to 2020 was $150 million, but the percentage change was 17.6%. By calculating the percentages, it is possible to use the information to compare with other years, but also with other companies in the same industry. This slide shows the income statement for Analytic and vertical analysis. Vertical analysis is the proportional expression of each financial statement item in a given period to a base figure. For example, Analytic Chemical's 2020 income statement uses total revenue as the denominator, and then each of the income statement amounts is shown as a percentage of total revenue. This helps to identify whether there has been a change in the percentage of the item in comparison to other years. Also, the percentages can be compared to other companies in the same industry. These are the quiz hints for Chapter 24. The first quiz will take you longer to complete, so plan to spend some more time on it. The second quiz is just calculating ratios using information that is provided and should not take much of the time. There is only one question that requires calculations for Chapter 24 as shown. This is the end of the presentation for Chapter 24, Full Disclosure in Financial Reporting.